So it's now widely expected that the Federal Reserve is going to cut rates in September. This could have major implications for your finances, investments, and the broader economy. So let's break down what's going on and why it matters right now. So, what do rate cuts actually mean? In short, it signals easier monetary policy ahead. Now, while this might sound like good news for investors and those who already own assets, it might mean higher inflation, and for the average person, that means the cost of living could continue to rise. Now, check this out. Directly from the CME FedWatch Tool, which tracks the market expectations for the Fed's move, as of now, there's a 94.9% chance the Fed will cut rates at its next meeting on September 17th. And that's nearly a guarantee. So, how did we get here? The answer lies in the disastrous jobs report that was released August 1st. Here's how it unfolded. In May, the government initially said we added 144,000 jobs, and that was later revised down to just 19,000. In June, it was reported the US added 147,000 jobs, but that was cut down to only 14,000. And for July, the forecast was 120,000 jobs, yet we only saw a 73,000 increase. And honestly, many expect that number to be revised down lower, possibly even into the negatives. The report was such a disaster that President Trump himself immediately fired the Bureau of Labor Statistics commissioner who oversaw those reports. Trump has been very vocal about wanting lower interest rates, and he's said it repeatedly. His concern is that high rates are choking the economy and slowing down growth. Now, Fed Chair Jerome Powell, on the other hand, has previously said they could afford to wait and see because the labor market seemed stable. Well, after this last report, the confidence is fading. Markets responded immediately. Before the jobs report, there was only a 41.3% chance of a September rate cut, and after the report dropped, the odds jumped over 82, and now they sit just shy of 95%. So here's the dilemma. The Federal Reserve's goal is to lower inflation to 2%. Right now, core PCE inflation, the Fed's preferred gauge, is stuck at 2.8, and it hasn't budged for over a year. And on top of that, tariffs are expected to push inflation even higher in the coming months. So, on one hand, inflation is too high to justify cutting rates. On the other, the job market is weakening. So it's a tough spot for the Fed. At the last FOMC meeting, Powell was asked what it would take for him to cut rates. His answer? He said he's looking at the totality of the data, which means up-and-coming jobs and new inflation reports will heavily influence the September decision. But with job growth looking this weak and more slowdowns likely ahead, that data probably won't be pretty.
Hi, Chair Powell. Thank you. Well, can you give us a little more about what kind of economic data does the Fed need to see before you'll be ready to cut? I mean, do you need inflation back nearly to target? Are there other things in the pricing that you look for? Do you need to see weakening in the job market? What kind of things are you looking for?
What will it take? It'll be the totality of the evidence. As I mentioned, there's quite a lot of data coming in, which before the next meeting. Will it be dispositive of that? It's really hard to say. We don't make those decisions right now, so we'll have to see.
Well, I guess just in terms of inflation, though, for example, some people would point to if it remains only in goods and it doesn't bleed over to services, then maybe that's evidence that the tariff effect is going to be a temporary one-time thing. Is that kind of thing affect your thinking, or do you just need to see the number come down closer to 2?
We'll look at everything. It's, as I mentioned, a pretty reasonable base case is that this will be a one-time price increase. And in the end, we'll make sure that that's the case. We're just trying to do that efficiently. And efficiently means getting the timing right so we don't again, if we cut rates too soon, maybe we didn't finish the job with inflation. History is dotted with examples of that. If you cut too late, then maybe you're doing unnecessary damage to the labor market. So we're trying to get that timing right, and that's effectively what we're doing.
Now, how can Powell justify a rate cut while inflation is still high? The only narrative that might work is this. Inflation could spike temporarily due to tariffs, but that's a one-time effect. At the last meeting, 2 Fed governors, including Vice Chair Michelle Bowman and Governor Chris Waller, voted in favor of a rate cut. Both were Trump appointees. But it still shows that even within the Fed, there's growing pressure to pivot. Now, this next meeting is especially important because the Fed will also update its projections. In June, they forecasted 2 rate cuts by the end of 2025. So if they do cut in September, they're likely to have to cut again soon, probably in October or December. So what's the takeaway? There's now a strong momentum and an expectation that the Federal Reserve will cut rates in September, but it's not a simple decision. They're caught between stubborn inflation and a slowing job market, and markets are watching closely. I'll be keeping an eye on every new development and keeping you updated. If this kind of breakdown helps you make sense of it all, make sure to follow for the next update. I'll see you in the next one.